What if I retire and the market goes down? This is one of the biggest, if not the biggest, concerns we hear. The fear of investment losses while in retirement. If you're listening in today, you probably have that concern too. We've helped many people overcome this fear, and in today's podcast, we'll help you too. When you're no longer working and you rely on your investments for your income needs, this is a valid concern. So today we'll share 3 key factors to help you overcome some of the fear you may have investing in retirement.
But what if you haven't saved enough for retirement? That's not what we're talking about. This podcast is for folks who have saved enough, but fear a market downturn may change that and create a situation for you that may change the lifestyle you've grown accustomed to living. I'm Mark Bova.
And I'm Lisa Conrath-Bova. We're the co-founders of Lenity Financial, a fee-only fiduciary registered investment advisor headquartered in Geneva, Illinois. Lenity Financial is a wealth management firm where we manage your wealth with discretion so you can live your life and not worry about the day-to-day of managing your money.
We are also financial planners, and while we don't require it, most of our clients, if not all, have a comprehensive financial plan, which is our map for your financial life. It helps you and us stay on track. Lisa and I have been married for 22 years. We first met aboard the Contiki, a party barge on Lake Michigan.
Wasn't a party barge.
Well, actually, we met in the office of a global wealth management firm where one Friday after hours, we all headed over to the Contiki for a dinner cruise, and the rest is history. So after nearly 2 decades of experience in financial services, Lisa and I felt compelled to create a better client and advisor experience than the one that we had been part of. We took the good and made it better.
While there was a lot of good that we took away from our experience at Lenity, as a financial advisor, it's great to have clients who feel like family to us. As a client, it should be optimal for you to have an advisor who feels like family to you. That's the Lenity financial experience in a nutshell, and one of the most important goals for us at Lenity. We also utilize our extensive experience and knowledge in managing money and wealth. Mark's experience included 6 years at a global wealth management firm, 4 years with a super regional bank, and nearly 8 years with a global asset manager. And I worked for one global wealth management firm for nearly 20 years as a vice president of investments and business financial advisor, working with families and business owners.
We're problem solvers, and one of the biggest problems we help solve is how to withdraw from your retirement assets. There are some key factors that we'll share today that will help you to reduce your concerns about your investments and withdrawals in retirement. Here's the first factor. Knowing your personal tax situation is one of the keys to understanding and creating your withdrawal strategy. Here's one example. Bonnie, not her real name, had just retired. She had both retirement account assets and non-retirement account assets. She had the idea that she should sell and distribute funds for her income needs from her larger accounts, her retirement accounts. But she wasn't certain, so she came to us seeking advice and confirmation that she was correct in her thinking. As it turns out, Bonnie wasn't correct in her thinking. In order for us to give her an answer, we first educated her of the importance of understanding her entire financial situation before making a decision. A comprehensive plan is a detailed view of your financial situation, and it's incredibly important to understand before you make a decision on your withdrawal strategy. This is a fact that most fail to understand, and Bonnie's example is a perfect one for you to see why it's so important. There were several details that played into our recommendation for Bonnie. After creating a comprehensive financial plan for her, we were able to show her a thorough analysis that showed her that she could potentially have nearly $1 million less for her heirs if she first removed money for her income needs from her retirement assets rather than her non-retirement assets. For Bonnie, it was a bit uncomfortable for her to use the funds she had accumulated in her non-retirement accounts. For a few reasons, but one big one was that she had a concentrated stock position in a stock that she absolutely loved and didn't really want to sell to cover her needs. And she was concerned about the tax consequences, naturally, of selling in her taxable account. An important point for you to remember is that your retirement assets can continue to grow tax-deferred or tax-free, depending on whether they're in a traditional or a Roth 401k or IRA. That tax benefit becomes one of the big reasons to keep those funds invested longer. One of the questions you should be asking is, what is the tax consequence of my withdrawal? In addition to inflation, taxation plays a large role in your wealth. One obvious example is the deferred tax liability that savings in a traditional IRA presents. We'll share more about tax in another podcast, so let's continue.
So remember 2020 and the pandemic? Of course you do. But do you recall the market falling 30% by the end of the first quarter? We had a new client come to us just a few months after that. Joe, not his real name, had panicked and sold just as the market hit bottom. He didn't sell all of his investments. He was fairly knowledgeable and knew that wasn't the best thing for him to do. But he did sell a substantial amount. He was just heading into retirement and hadn't planned for a crash like the pandemic market downturn. He was afraid. Now, we get it. In the absence of guidance and a plan, selling may seem like the best thing to do to stop the losses. Candidly, we've even had people come to us who had an advisor that told them to hold on and not sell, but they did anyway. We believe, at least in part, it was because they didn't really have the knowledge they needed to understand their full financial withdrawal strategy, and were fearful they may run out of money in retirement. In addition to taxation, we know that the structure of your money is a big factor in the withdrawal strategy and will allow you to weather those market downturns. So keep listening. Maybe you felt like Joe. The emotions that come with thinking of retiring can be overwhelming. Add to that, your own money is now the source of your retirement paycheck. There's a little discomfort that comes with no longer having that paycheck coming from your employer. Your investments become the source of your retirement paycheck, and that for many is unnerving, especially in times when markets are volatile. When you think about creating your paycheck from the wealth you've accumulated, you may be considering a reduction in your stock market exposure. We often hear that from people who are in process of picking their retirement date, that they plan to reduce the amount they have in the stock market and invest more in bonds. While reducing the risk you're taking on your money in retirement may be necessary, but it's important to understand whether or not moving those funds to bonds is the best answer, or rather, whether or not it's actually a reduction of risk on your money. Now, here's an example of what I mean. If you were invested in longer dated bonds in 2022, both intermediate and long-term bonds and stocks fell in value almost equally. At one point, the 30-year Treasury bond was down in value as much as 30%. That was as much as the NASDAQ 100 index at that time. If you were using those bonds as part of your withdrawal strategy and needed to withdraw from them at that time, you could have lost big. So simply adding bonds to your portfolio isn't necessarily the answer.
The structure of your money, as Lisa mentioned, is a big factor in your retirement withdrawal strategy. But instead, many advisors do something called asset allocate. They introduce a conservative, moderate, or aggressive model to invest in that they believe is an asset allocation created to meet who you are as an investor, conservative, moderate, or aggressive. I'm sure you've heard this before. Well, in a market like 2022 and into 2023, that asset allocation model didn't work. We've seen it too many times. A new client brings us their account statement from the previous firm. We see line item after line item of mutual funds. Neither the client nor the advisor manage the account, really. The advisor may manage the managers, but they don't really have much control. We've seen as many as 21 mutual funds recently on a managed account statement from a very well-known asset management firm. Yet we took a deep dive for our now client and helped them to see that the fees they were paying weren't paying off for them, just for the investment firm. The client had felt that this was the case, but couldn't tell for sure. We were able to show them in real terms by looking under the hood of each investment and showing them where the dead weight was laying or what was holding down the performance on their money. We'd like you to start thinking of your investments like a hot air balloon. Yep, that's what I said, a hot air balloon. And here's what I mean. You have a finite amount of money. By allocating as efficiently as possible, it may afford you the luxury of having liquidity available to sustain you over a longer period of time than otherwise. If you, for a moment, imagine your portfolio like a hot air balloon, and your balloon is currently grounded. So in order to lift off, you'll need to let go of some of the weight in order to lift off. Consider poorly performing assets as dead weight. In order to grow your money, you need to prune that dead weight along the way. This is another key factor in your withdrawal strategy.
Does this sound familiar? Do you have accounts with lots of mutual fund line items, but maybe not great performance on your money? We have seen this time and time again, a mismatch of risk tolerance and structure on money. We call it hyperallocation or diversification for the sake of diversification, not for the sake of structure, which is more critical in retirement. Those asset allocation models for conservative or moderate have too often not served you well. You understand this if you had to withdraw your funds in 2022 and early 2023, and you had to sell both your bonds and stocks at lower levels, or in some cases, even losses. Both stocks and bonds were down. In other words, you may have been forced to be a price taker, not a price maker. Forced to sell when you needed income for your monthly expenses at a time that was not advantageous to you. Now, we know from our experience that asset allocation models don't do what you need in retirement. It's in fact the structure of your money that is of critical importance to help you have peace of mind. Remember, both bonds and stocks can be volatile, and you have experienced that as an investor. But not all bonds are volatile, and it's critical to choose wisely when choosing bonds as part of your withdrawal strategy. Unfortunately, we see so often that people or their advisors haven't chosen wisely and are forced to withdraw from investments at an inopportune time.
Let me unpack that a bit to help you understand perhaps why your advisor hasn't structured your money to meet your goals and needs, but has instead put your money in an asset allocation model. When Lisa and I first started Lenity Financial, we just happened to see a help wanted ad in our local paper for a nationally recognized financial firm, in fact, a household name. The ad was looking for financial advisors to manage between 400 and 500 relationships of $1 million or more. Wow. If you're one of those 400 or 500 clients at that firm, you couldn't possibly have a relationship, really, with your advisor, and your advisor could not possibly know your needs. In order for that advisor to manage all of those clients, they can only resort to asset allocation models. They could not, and clearly have not, as we've seen from many an account statement from people not well served by this, they couldn't possibly properly structure your money to meet your needs. They don't have the time it takes to help you and really understand your income needs. Structure is one of the most important ways we help our clients sleep at night, and us too.
Yeah.
We care a lot about how our clients are enjoying their lives and are they living comfortably as they have been accustomed to living before their retirement. We know that the structure of your money is one of the most important factors to your success. Your success in retirement, as we see it as an advisor, is not outliving your money while living the lifestyle you've grown accustomed to living. The absolute only way to do this is within the structure of your money.
At the beginning of our podcast, we told you that we'd help you too, just as we've helped our clients. Well, here's part of that help. The only way not to have risk of loss on your money is not to put that money at risk. I'll repeat, the only way to not have risk is to not have risk. Yet, one of the biggest obstacles to people meeting their goals and investing is being out of the market. So depending upon your goals and needs for your money, some of that money really shouldn't be at risk, while other of your money really should take on some risk. In volatile times, as investors, we're being compensated for taking on a certain amount of risk on our investments. Just what amounts in each of the no risk, low risk versus risk buckets depends upon you, your goals, and needs. For us, no risk is cash, and low risk is near cash or short-term bonds. By structuring your no-risk, low-risk assets to meet your retirement paycheck needs, you avoid selling an asset and being a price taker rather than a price maker. Your retirement paycheck should come from no-risk, low-risk assets. Those assets can be cash, near cash, and short-term bonds, with dates maturing to meet your income needs. You may be thinking, there's risk in being in the market, and yes, that's true. So consider structuring your money so that the portion you need to live on is at no risk. This is the only way to avoid the pitfalls of the average investor, whose emotion and needs so often conflict with the market's movements, especially when the markets go down. Did you know that if you missed the 10 best days in the market over a 20-year period, you would have likely shed over 50% of your ending portfolio value? Or going back to 1930, if an investor missed the S&P 500's 10 best days in each decade, total returns would be just 91%, significantly below the 14,962% return for investors who hold steady through downturns. But did you know that often the best days take place during bear markets? Over the last 20 years, 7 of the 10 best days happened when the market was in a bear market territory. Adding to this, many of the best days take place shortly after the worst days. And the average investor simply hasn't stayed invested fully to reap the benefits of these days. Why? Because emotions, panic selling, and selling to meet financial needs are reasons we believe investors without a structure on their money return less.
So to master your fear of investment losses, whether near retirement or in retirement, we believe the most important factor in determining your outcome and peace of mind is the structure of your money. Ask yourself, do I have enough in cash, in near cash, in short-term bonds, in dividend-producing investments, in stocks, in alternative investments?
You invest over your lifetime to create wealth, provide yourself and your family with peace of mind that you'll have options in your future, to reduce the impacts of taxation and inflation on your money, and to be good stewards of your wealth. It's important to understand that there's a better way to manage your money. That better way includes a great financial partner where you have a relationship, someone who truly understands not only your financial situation in a comprehensive manner, but also your personal goals and dreams. And structure your money to meet your goals and needs. We've talked about not having just an asset allocation, but rather a structure to your investments that keeps you invested through the market cycles and the years in retirement. The structure of your money will help you to be more confident, less stressed during the various market cycles and through your retirement years. We hope you've enjoyed this podcast, and we hope you keep going to our website to join us for future podcasts where we'll unpack more of the structure of your money.
If you've enjoyed it, please like this podcast, share it with your friends, coworkers, and family. Follow us on LinkedIn, Facebook, Instagram, and X. And go to our website at lenityfinancial.com and connect with us.